Welcome to today's video titled 9 Human Biases That Destroy Investors. Understanding human biases in investing, particularly in the crypto and DeFi space, is crucial for making sound investment decisions. Many investors fall prey to psychological traps that lead to poor choices and missed opportunities. In this video, we'll delve into 9 common biases that can sabotage your investment strategies and discuss how to mitigate their impact. First on our list is overconfidence bias. Overconfidence bias occurs when investors overestimate their knowledge or ability to predict market movements. This overestimation leads them to take on excessive risk, often ignoring potential warning signs. For instance, an investor might believe they have a foolproof strategy, investing heavily without adequate research or risk management. This can lead to substantial losses, especially in the volatile crypto market. To combat this, always question your assumptions and validate your strategies with thorough research and peer reviews. Overconfidence, bias in detail. Overconfidence is not just about believing in your own abilities, but also underestimating the complexity of the market. This bias can lead to overtrading, where investors make frequent trades based on their perceived edge. Research shows that overconfident traders often experience lower returns due to increased transaction costs and poor timing. To manage this, consider maintaining a trading journal to track your decisions and their outcomes. This can provide a reality check and help you recognize patterns in your behavior. Having said that, if you check the first link in the description, you can have confidence that your portfolio is going to grow against inflation over time and even bring you considerable gains along the way. Confirmation bias. Next, we have confirmation bias. Confirmation bias is the tendency to seek out information that confirms our preconceptions while ignoring contradictory evidence. An investor might read only articles that support their belief that a particular token will surge in value, disregarding any negative analyses. This selective exposure can skew decision-making and result in holding onto poor investments. To avoid this, actively seek out and consider opposing viewpoints, and ensure your research encompasses a broad spectrum of information sources. Avoiding confirmation bias. One effective strategy to combat confirmation bias is to use a structured decision-making process. For example, write down the reasons for and against an investment before making a decision. Additionally, engage with communities or forums where diverse opinions are shared. Platforms like Reddit or crypto-specific forums often host debates that can provide a balanced view. Remember, the goal is not to confirm what you already believe, but to challenge it and refine your investment thesis. Loss aversion. Loss aversion is another critical bias. This is the tendency to fear losses more than valuing equivalent gains. The pain of losing $100 is often more significant than the pleasure of gaining 100. This fear can lead investors to make overly conservative choices, missing out on profitable opportunities, or panic selling during downturns, locking in losses. Recognizing this bias helps in maintaining a balanced perspective and sticking to a well-thought-out investment strategy even during market volatility. The impact of loss aversion. Loss aversion can also lead to holding onto losing investments for too long in the hope that they will recover. This is known as the disposition effect. To mitigate this, set predefined stop-loss levels for your investments and stick to them. Automating these decisions can help remove emotional interference. Moreover, practice visualizing worst-case scenarios to desensitize yourself to the fear of loss, which can help in making more rational decisions. Herd mentality. The fourth bias is herd mentality. Herd mentality drives investors to follow the crowd, buying into trends without conducting their own research. When everyone is buying a particular cryptocurrency, it can be tempting to follow suit, assuming the collective wisdom is correct. However, this can lead to buying at inflated prices and suffering when the bubble bursts. It's essential to conduct independent analysis and base your decisions on solid fundamentals rather than the actions of the majority. Recognizing herd mentality. Herd behavior can be particularly dangerous in the crypto space, where hype and FOMO, fear of missing out, can drive irrational market behavior. To avoid falling into this trap, establish a set of investment criteria that must be met before making a purchase. This could include technical indicators, fundamental analysis, or specific market conditions. Additionally, consider diversifying your information sources to avoid echo chambers. Recency bias. Recency bias is another common issue where investors place too much emphasis on recent events or trends, expecting them to continue indefinitely. For example, if a cryptocurrency has been performing well in the past few months, an investor might assume this trend will persist, disregarding the cyclical nature of markets. This can result in poor investment choices based on short-term patterns rather than long-term potential. To mitigate recency bias, always look at the broader historical context and underlying factors influencing market movements. Overcoming recency bias. To counter recency bias, regularly review historical performance data and consider long-term trends over short-term fluctuations. Utilizing tools like moving averages can help smooth out volatility and provide a clearer picture of an asset's trajectory. Moreover, incorporating a broader range of timeframes in your analysis can help balance recent performance with long-term potential. Availability bias? Availability bias affects investors when they rely on readily available information rather than seeking out all relevant data. This can lead to a skewed understanding of the market and suboptimal investment decisions. For instance, media coverage of a particular token might be overwhelmingly positive, but without deeper research, one might miss critical issues underlying the asset. Ensuring you dig deeper and gather comprehensive information before making investment decisions is vital. Strategies to combat availability bias. To mitigate availability bias, develop a habit of conducting thorough due diligence. This includes reading white papers, analyzing on-chain data, and understanding the technology behind the projects. Additionally, use multiple information sources and cross-reference the data to get a well-rounded perspective. Keeping a research checklist can ensure that you don't overlook critical aspects during your analysis. Disposition effect. The disposition effect is another bias to watch out for. This occurs when investors sell assets that have increased in value, while holding onto those that have dropped, hoping they will rebound. This behavior locks in gains prematurely and holds onto losing investments for too long. To overcome this, regularly review your portfolio and make decisions based on the current outlook and fundamentals of each asset rather than past performance. Managing the disposition effect. One way to manage the disposition effect is to establish clear investment goals and exit strategies before making any trade. Use tools like trailing stops to lock in gains while allowing for potential upside. Regular portfolio rebalancing based on predefined criteria can also help maintain discipline and avoid emotional decision-making. Endowment effect. Endowment effect is the bias where investors value assets more highly simply because they own them. This can lead to emotional attachment to certain investments, preventing rational decision-making and necessary portfolio adjustments. To counter this, try to evaluate your investments as if you didn't own them and make objective decisions based on their potential and fit within your overall strategy. Strategies to overcome the endowment effect. To mitigate the endowment effect, periodically review your portfolio with a fresh perspective. Imagine you are advising a friend and consider what changes you would recommend. Additionally, setting predefined criteria for holding or selling assets can help remove emotional attachments. Objective metrics like performance benchmarks and risk assessments can guide these decisions. Sunk cost fallacy. Lastly, we have the sunk cost fallacy. This bias occurs when investors continue to invest time, money, or effort into a project even when it would be better to abandon it. The reasoning is that they have already invested so much that they feel compelled to continue. However, rational investment decisions should be based on future potential rather than past investments. Acknowledge past decisions and focus on the best path forward, without letting previous commitments cloud your judgment. Overcoming the sunk cost fallacy. To counter the sunk cost fallacy, practice focusing on the future potential of investments rather than past expenditures. Conduct regular reviews to assess whether an investment still aligns with your goals and criteria. If it doesn't, be prepared to cut your losses and reallocate resources to more promising opportunities. Keeping detailed records of your investment decisions can help identify when you're falling into this trap. Understanding and mitigating these 9 biases, overconfidence bias, confirmation bias, loss aversion, herd mentality, recency bias, availability bias, disposition effect, endowment effect, and sunk cost fallacy can significantly improve your investment outcomes. In any asset class, but especially in the DeFi space, awareness is the first step. Regularly reflect on your decision-making processes and identify if any biases are influencing your choices. In conclusion, investing in the DeFi space offers immense potential, but it's fraught with psychological pitfalls. By recognizing and addressing these biases, you can make more informed and rational investment decisions. Conduct thorough research, seek diverse viewpoints, maintain a long-term perspective, and be willing to adjust your strategies as needed. Thank you for watching. Don't forget to subscribe, and hit the notification bell for more insights into the world of finance and investing. Let's embark on this journey together towards smarter, bias-free investing.